Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Ctf Services Limited, interim report. Ctf Services Limited is a diversified conglomerate company with a wide range of businesses across various sectors. The company's portfolio includes toll roads, insurance services, logistics management, construction and facilities management. In the transportation sector, it operates toll roads and engages in piling and ground investigation activities. In the insurance sector, Ctf Services Limited offers a variety of products and services including life insurance, medical insurance, critical illness insurance, personal accident insurance, saving insurance plans, annuities, and investment-linked assurance schemes for individuals and institutions. The company also provides employee benefit solutions to its clients. The construction and facilities management segment is another key area of operation for Ctf Services Limited. It offers general contracting, construction management, and civil engineering and foundation work services for residential, commercial, governmental, and institutional sectors. Additionally, the company manages and operates venues for exhibitions, conventions, meetings, entertainment events, banquets, and catering events. In terms of property investment and management, Ctf Services Limited provides agency, consultancy, and financial services including bond issuing and catering services. The company also manages car parks, commercial complexes, and hotels. With a presence in Hong Kong and the mainland, Ctf Services Limited is well positioned to capitalize on growth opportunities across various sectors. The stock price of Ctf Services Limited has experienced a significant increase of 41.97% over the past year, outperforming the market average. Several key events have likely contributed to this surge in share value. One major factor was the company's interim results announcement in February 2026, which showed a 15% year-on-year growth in profit attributable to shareholders and a 3% increase in attributable operating profit. The strong financial performance and positive outlook for the full year 2026 boosted investor confidence. Additionally, Ctf Services' decision to raise up to RMB 5 billion through debt instruments in January 2026 was seen as a strategic move to enhance its capital structure and financial flexibility. This announcement led to an 8.9% increase in stock value on the same day. The company's ongoing acquisitions and investments have also played a significant role in driving up its share price. Strategic purchases of industrial logistics properties, stakes in various companies, and investments in new business segments demonstrate Ctf Services' commitment to expanding and diversifying its portfolio. Lastly, adjustments to the conversion price of convertible bonds and the declaration of an interim dividend in February 2026 further contributed to the positive sentiment among investors. These events collectively created a favorable market environment for Ctf Services Limited, resulting in its impressive stock price growth over the past year. Ctf Services Limited market capitalization of 39 billion is significantly larger than the average industry peer of roughly 0 billion. This shows that Ctf Services Limited holds a significant advantage in their industry. Ctf Services Limited trades at a higher price-to-earnings ratio of 17 times and a lower price-to-book ratio of 1 times relative within the industry. But when we look at the broader industry, much for its peers are also priced fairly or higher. This indicates an overall sector-level optimism, suggesting that investors are already valuing the industry with a forward premium for the industry, leaving limited opportunity to uncover undervalued stocks. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has declined over the past 5 years, but operating income remains positive. The equity weakness may stem from capital structure changes such as buybacks or dividends rather than operational deterioration. The share count has increased while revenue and shareholder equity are declining. This indicates that management has not yet proven the business model is sustainable. This makes the investment case highly unfavorable. The company have a dividend yield of 7.22%. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline can be identified through a thorough analysis of the provided data. On the growth side, several segments and factors have contributed to the increase in revenue. Financial services has been a significant driver of revenue growth, with a 19% increase in page 11. Strategic investments have also seen a substantial growth of 78% in page 11. The construction segment has experienced a remarkable 115% year-on-year increase in newly secured contracts in page 15, while the facilities management segment has seen a 360% year-on-year AOP increase in page 15. Other key drivers of revenue growth include the strong performance of Chow Tai Fook Life Insurance Company Limited, CTF Life, and profitable new business growth. Favorable financial market movements have also contributed to revenue growth, as well as increased annual premium equivalent (APE) in agency and partnership channels. On the other hand, there are several drivers of revenue decline. The logistics segment has seen a decline of 14% in page 11, while the construction segment has experienced a decline of 21% in page 11. The road segment has also seen a decline of 1.7% in page 38. In addition to these segment-specific declines, interest income has decreased by $27 from the previous period in page 43. Gross rental income from investment properties has declined by 15% in page 45. These factors have contributed to the overall revenue decline. Overall, a combination of strong performance in certain segments and favorable market conditions have driven revenue growth, while declines in other segments and interest income have contributed to revenue decline. The net income of the company experienced a significant increase over the past 2 years. In 2025, it rose by 15.2% from $157.6 million in 2024 to $334.3 million. This upward trend continued in 2026, with an additional 12.7% increase to $428.4 million. However, the profit margins of the company showed a mixed performance during this period. The attributable operating profit decreased by 2.7%, from $225.3 million to $283.9 million. On the other hand, the adjusted EBITDA increased by 1% from $556.8 million to $591.4 million. These contrasting results suggest that while the company's net income is growing, its profit margins are not necessarily improving at the same rate. The company is indeed generating positive operating cash flow, as evident from the financial statements provided. On page 29, it is stated that the net cash generated from operating activities was $61 million in 2025, and a significantly higher amount of $589.6 million in 2024. However, upon closer inspection, we find that the actual figure for 2025 is $605.8 million, page 68, which is a substantial increase from the previously mentioned $61 million. This suggests that the company's operating cash flow has improved significantly over time, indicating a positive trend in its financial performance. In conclusion, based on the provided information, it is clear that the company is generating positive operating cash flow, with a notable improvement in 2025 compared to previous years. The company's debt level has undergone significant changes over the years. Initially, it decreased from $14,651.1 million to $13,809.9 million on page 5 and further, reduced by 6% from $14.7 billion to $13.8 billion on page 8. However, on page 44, there was a notable increase of 29% in debt level from $140,976.60 to $182,161.20. On the other hand, interest expenses have shown some fluctuations. On page 7, it decreased by 14% due to favorable SOFR movements and redemption of perpetual capital securities. However, on page 73, there was a slight decrease in interest expenses from approximately 4.2% per annum to approximately 4% per annum. It is worth noting that the company's debt level has increased significantly on page 44, which may impact future interest expenses. Nevertheless, the overall trend of interest expenses remains relatively stable, with some minor fluctuations throughout the years. The recent analysis of various business segments and regions has yielded some notable insights. On the positive side, the the financial services sector has shown impressive performance, as highlighted on page 6. Additionally, facilities management, particularly Gleneagles Hospital Hong Kong, has also demonstrated strong results. In contrast, two areas have underperformed: construction and logistics. These sectors have struggled to meet expectations, indicating potential challenges that need to be addressed. Overall, the analysis suggests a mixed bag of performance across different segments and regions, with some shining bright while others require improvement. Management's outlook for the company is one of strategic growth and optimization. The company plans to direct capital towards segments with long-term potential, making targeted investments and divestments to support future initiatives. This approach aims to enhance the business portfolio and drive sustainable growth. In terms of specific sectors, management expects improved toll revenue from the Tianjin Expressway following expansion works, which will increase the average remaining concession period to approximately 22.8 years by 2028. Additionally, the company is proactively managing near-term occupancy pressures through strategic recalibrations to diversify its tenant base and enhance asset visibility. Management also acknowledges that the toll road sector in China will face persistent uncertainties, but they are prioritizing operational agility to adapt existing assets to the evolving transportation environment. To achieve this, the company is maintaining a diversified and balanced debt profile, expanding funding sources, optimizing funding cost efficiency, and managing currency exchange fluctuations through natural hedges. Furthermore, management is taking steps to optimize the business portfolio by disposing of certain interests in listed associated companies and exploring opportunities to selectively acquire undervalued logistics properties. Overall, the company's strategy focuses on long-term value creation, financial flexibility, and adaptability in response to changing market conditions. The company has made several significant acquisitions and divestitures over the past year. In terms of acquisitions, the company has expanded its logistics portfolio with the purchase of multiple properties in key locations such as Dongguan, Yangtze River Delta, Shanghai, Ningbo, and Changzhou. These acquisitions have increased the company's gross leasable area to approximately 1.7 million sq.ft. The company has also acquired a significant stake in Blackhorn Group Limited, holding 65% of its shares, and a smaller stake in Usmart Inlet Group Limited, with 13.05% ownership. Additionally, the company has invested in various other logistics properties, further solidifying its presence in the industry. On the divestiture side, the company has disposed of its loss-making free-duty business, which was no longer profitable. The company has also monetized its investment in Shaocheng Holdings Limited through the issuance of exchangeable bonds, effectively reducing its stake in the company to 10%. These strategic moves demonstrate the company's commitment to optimizing its portfolio and focusing on high-growth areas. The company has a history of paying dividends to its shareholders. Specifically, it paid an interim ordinary dividend of $0.28 per share for the fiscal year 2026 and a special dividend of $0.30 per share for the fiscal year 2024. This demonstrates the company's commitment to returning value to its investors through regular dividend payments. In addition to paying dividends, the company has also engaged in share buybacks, albeit not in the traditional sense. Instead of repurchasing shares directly, it has utilized scrip dividends or convertible bonds to achieve this goal. For instance, on page 63, it is noted that the company repurchased $566 million in aggregate principal amount of 4% convertible bonds. This approach allows the company to return value to its shareholders while also managing its capital structure and financial obligations. Concerns about inventory buildup and supply chain disruption are valid based on recent reports. The logistics segment reported a high inventory level of $7,365.8 million, indicating potential issues with managing stock levels. Furthermore, the sector has faced challenges in maintaining a smooth supply chain. The road segment experienced uneven traffic recovery and partial closures on certain expressways, which could lead to delays and disruptions. Additionally, ATL's operational performance was temporarily affected by market volatility arising from reciprocal tariffs, highlighting the vulnerability of the supply chain to external factors. These issues suggest that there are legitimate concerns about inventory buildup and supply chain disruption in the sector. That concludes the financial summary for Ctf Services Limited. Feel free to comment below and I will be happy to answer them when possible.